Hello and welcome to Donut Investment. This analysis is for Synchrony Financial on the New York Stock Exchange as of 7th of August 2026 with a share price of $78.67. The full report is on donutian.ca. Synchrony is a high-return consumer credit franchise trading at 1.69 times tangible book, and after a 9.6% rally, it has reclaimed its 200-day moving average. That flips the timing pillar from bearish to strongly bullish and upgrades the short-term call from hold to buy, joining the medium and long buys. The technical entry is now confirmed at full-size conviction. The catch is the consumer credit cycle. The quality here is real. Synchrony earns a return on equity around 21% through the cycle, on card economics that give it a return on assets several times a typical bank, and it runs a lean cost base. Yet the shares trade at just 1.69 times tangible book against a warranted multiple capped at 3 times. That is a ratio of 0.56, squarely in the attractive band, and on trailing earnings it is about 8 times. On top of that, a roughly 14% a year buyback and a 1.7% dividend keep shrinking the share count. Cheap for the returns. This is what changed. In late July, the stock sat below a falling 200-day average in a bearish tape, and the short call was hold. After a 9.6% rally, it has reclaimed both its 50 and 200-day averages, and the monthly, weekly, and daily trends are all pointing up, with the relative strength index near 60. Room before overbought. That lifts the timing pillar to 63 and confirms the technical entry, so the short-term signal upgrades from hold to buy and the conviction steps up to full size. 2 of 3 entry groups met. It is no longer a wait. The driver is the health of the everyday American consumer, and right now it is genuinely contested rather than a clear headwind. Second quarter net charge-offs and delinquencies improved, and management raised guidance, so credit is normalizing favorably, but it is the unhedged swing factor. The macro report flags private credit stress building, and the August 1st tariff wall pressing on the lower-income consumer Synchrony serves. A neutral driver does not amplify, which is why this is a plain buy on the fundamentals and the tape, not a stronger one, and why the caution flag stays on. The risk here is cyclical, and it is the reason the stock is still cheap after the rally. The bear case sees the shares fall to about $66, roughly 16% below today. That takes a stagflation-light consumer squeeze, with the tariff wall spiking net charge-offs and delinquencies, forcing a reserve build that dents earnings, or the private credit stress the macro report flags, spilling into consumer credit. There is also a competitive tail. Synchrony depends on a finite set of large retail partner programs, and losing one is a step change, not a trickle, as with the historic loss of the Walmart program, while buy now pay later fintechs chip at checkout, and as a high-sensitivity financial it moves on the macro prints. This is a real risk, not a distant tail. Now weigh the risk against the reward. The bull case is roughly 27% above today, the base case, the most likely, about 12%, and the bear case, a fall of about 16%. So you are risking about 16 to make 27. So, our call on Synchrony Financial on the New York Stock Exchange, buy. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donutian Investment at donutian.ca. The link to the full report is in the notes below. Have a great day.